Mike Brandoni with Insurance Network America, and I hope everybody's having a great day. And today our discussion is going to be around don't assume you know your client's overriding fears. John Morrill from ING is going to be our featured speaker. John is a graduate from the University of Michigan with a Bachelor's of Arts in Engineering. John began his insurance career with Midwestern broker-dealer and insurance coordinator, and worked for financial planners expanding their life insurance sales. In '96, he relocated and joined Security Life of Denver, which is now part of ING USA. John is the sales vice president for the Rocky Mountain region, and so I'm going to turn to John. Are you there?
Yes, I am. Can you hear me?
I can hear you. We're all good to go. Now, everybody, this is in a listen-only mode for the participants, and so as with the others, you can either ask a question through the question box or the chat box, and we will get to them either in the middle of the presentation or at the end. So I'm going to transition the slide presentation over to John right now. And John, you should be able to take controls. And there you are.
Excellent. A little bit of orange on the screen. Thank you, Mike. Thank you, everybody.
Okay, you're all set.
For spending a few minutes with us this morning. We have a lot of good ideas to talk about today. I'm looking forward to walking you through, a few things that we see in the marketplace, some opportunities, some pitfalls. What do our clients really want, and what are they fearing today? When Mike and I had set this presentation up a few months ago, a little bit different focus, but as we're seeing the AG 38 and some of the other pressures with low interest rates, took a little bit focus away from guarantees, direct products. We're going to spend some time on what can we show our clients that will alleviate some of the challenges that they're running into. Got a few slides here that you might recognize from a couple years ago at one of the INA summits. I think these days it's kind of apropos. I believe this is one on top of the one of the tall buildings in New York, and there's a couple different things that the people will see as fears. I'm not a big fan of heights, so this might cause a bit of vertigo just looking at the screen. But you know what? There's a lot of people that get thrills from climbing up on doing bungee jumping and things like that. So different things bring different opportunities or different emotions to us. This next one is just that's probably just a fear of someday we're going to be on the wrong end of the elephant. I don't really know where the positive is there, but do we feel that we're getting beat up by, if you're on the employee benefits side by PPACA, or if you're on the investment side of the world by a volatile stock market, or in our industry we have the NAIC, we've got low interest rates, we've got a lot of things pushing at us, and sometimes it might feel that we're getting a little bit close to the dangerous avocations or vocations. So one of the things I think that we're going to spend most of our time today talking about is the excitement of having really low interest rates. Not too long ago, we thought interest rates couldn't get any lower, and you know what? We expect them to go up, and hopefully go up fairly soon, because it was hard for us to plan for our own retirement and our clients' retirement when you're not getting a lot of return on your dollar. So here it just talks about the Fed saying, hey, act now, get an amazing 0% financing, all inventory must go, blah, 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 blah. So that's kind of where we're going to start our talk, and we'll talk about different products. We'll talk a little bit about how life insurance is a tool that today can show your clients a couple different options. It really is building your clients' options, whether it's being something like building a laddered term portfolio or a laddered CD or however that works, whatever fits your client's needs. one of the things we have to balance is interest rates have been clearly defined as being low for the next couple of years. This was September 13th, about a month and a half ago. The Fed promises low interest rates. Just like the guy on the last screen, who was jumping for joy? Well, maybe there was Ben Bernanke. He actually refinanced his own home to take advantage of those low interest rates. Let's go back up here. He released a statement saying the central bank's going to keep interest rates low for the next couple of years. The next, and these are my highlights, good news for people looking to get a mortgage, bad news for people relying on interest-bearing retirement savings accounts. That's what we do. We find different tools to help our clients plan for, it's as the old adage from years ago, dying too soon, living too long, and perhaps being disabled in the meantime. Those are the things we plan for. Those are the long-term commitments that ING and other carriers have to take the premiums and the money given to us and do the best we can. Well, doing the best we can is not what it used to be. So the silver lining in all this is go out and refinance your house. Ben did. I don't know what other silver linings are there. Maybe the other one might be our debt is going to be, the U.S. government debt is going to be cheaper for a while. Well, that's a good thing. But let's take a look at what mortgages are. They're cheap, super, super cheap. Now, they're a little bit higher than they were perhaps a couple months ago, but I'd say this is the good. And then we're going to start seeing, okay, well, that's a positive for your client. Now to sort of start our glass half empty side is going to be, this is CD rate history going back to '84. The last couple of years they keep pivoting, keep sliding down, getting, people aren't sure where to put their money to get a risk-free return anymore. And if they're looking for risk-free, it's almost interest-free as well. And oh, by the way, you still have to pay taxes on that. So that's something we have to keep in mind. And when we are comparing the products that we can use with life insurance attached to it, we don't really have a big hurdle rate. Take a look at, this is a one-year CD rate. This is about a month ago. 1%. That should be pretty easy for us to talk to our clients and give them a better alternative. What is that? Well, what I'm going to do today is walk through about 4 or 5 different places that you may not have thought about where we can use life insurance, from term all the way to permanent and survivorship. How can we get a client in a better position? Is this a client that needs current income, or is this someone who is protecting their family, or is this someone who may need the cash for a chronic illness or nursing home stay, but otherwise, just looking for a better way to pass it down to their children or their grandchildren. So when we're taking a look at how life insurance is positioned against a one-year CD, we should be jumping for joy. But you know what? We're comparing what the products might have been a year ago or 2 years ago or back in the mid-90s, early 90s when we were paying 8 or 9 or 10% on a policy for a crediting rate. So we're going to look at a couple of these opportunities using life insurance. These are sales opportunities driven by low interest rates. Are they going to always work? Not always. If interest rates pop back up, maybe they aren't going to work as well. But you know what? Right now, these are really good stories as you go through your book of business, looking for different opportunities. Clients, especially retirees, they've got to be pretty scared because that CD that they might have been able to live on was doing okay. That Social Security going up every year with cost of living, that was all right. Pensions, they were growing all right. Challenge now is there's a couple different ways of measuring inflation. Those may not be keeping up with the inflation that we all feel when we go to the grocery store and we buy chicken and corn and flour and sugar and all those things, because those are getting more expensive. Well, heck, gasoline. My sister lives out in California. If anybody's on the call from California, I feel for you. I hope you aren't driving a big gas guzzler like lots of folks are, because it's got to be fairly painful. But we're going to talk about income replacement death benefit calculations, meaning if somebody has calculated a death benefit 5 or 10 years ago to take care of their family if something happens to them, gosh, is that accurate anymore? We're going to look at return of premium term insurance. How can you position that for your client who may be looking for something, another place to put a little bit more money? And if we can show them that it's a good rate of return, gosh, they might think that's a good place. We're going to look at CD alternatives. Again, CDs are paying 1%. What else is available out there? And finally, a concept that we have called Legacy Max, using a couple different products that we have in our portfolio. So we're going to take a look at income replacement death benefit calculations. What does this mean? And if you look at sort of the standard paradigm has been, okay, you earn $75,000, take a 10 times multiplier, you need to buy $750,000 worth of life insurance. And I think that's been kind of a long-term standard calculation to figure out what's the right amount of insurance for somebody. I think even Susie Orman and Dave Ramsey might say, you know what, if you're going to buy life insurance, 10 times is probably a good start. Well, years ago when interest rates were a lot higher, if you were able to get 10% on a fairly regular basis on your money, that's replacing your income. If you have $75,000 of income, you buy $750,000 worth of death benefit. God forbid something happens to you. Now, someone's managing that money, or maybe your surviving spouse is managing the money. Get 10%, great. $75,000, boom, that's replaced. Well, what happens now? 1%. That's $7,500 of income. Okay, maybe we can get 4%. Well, that's $30,000 worth of income. Oh, by the way, that's taxable, but it would have been, on the income side as well. Do we need to recalculate? We have a great tool. This is our life needs analysis. It's a one-pager. I had a flyer at the summit a couple months ago. I've heard from a lot of people this is a great one-page. You can do it on your tablet. You can do it on your iPad, although it's not an app. You can do it on your desktop. You can do it on your laptop, whatever. What you can do is on this one page, and I've simplified this just to make the point of assumptions of how much someone's going to get on their money that their beneficiary gets. Should we be recalculating that 10 times income? Or should we be recalculating just overall how much do they need? So what I did here is I took that one page, I zeroed out all the cash needs at death, and we're just going to say, okay, the survivor, let's say my wife, I'll say, okay, we think $60,000 of annual income would be enough. Now, we have a 4-year-old, okay, maybe 20 years is how long you want to provide that income. And then you can plug in towards the bottom here, anticipated rate of return and anticipated inflation rate. Just to make it simple, I kept the inflation rate down to 0. So we're probably underestimating how much death benefit is needed here, and I'm anticipating a 5% rate of return. Now, being pretty conservative here and not overbuying on the insurance, I just kind of want to figure out what is the baseline need. Gosh, if you can get 5% on your money, and that money is going to run out over the next 20 years. So you're eating away the principal down to 0 in 20 years. Your need was $760,000. So for a $60,000 income replacement, $760,000, so a little bit more than 10 times, 12 times-ish, at 5%. Now what happens if we just change that 3%, I'm sorry, 5%, we reduce the 3% down to a 2% anticipated rate of return. So now we're going to gobble away that principal, and we're going to still end up with 0 in 20 years, but now it's getting a 5%. We're saying, okay, you know what, I think year in, year out I can get 2%. Yeah, I can get a 5-year CD of 2% or so. Now I need almost $1 million. So it's gone up about 20 or 30%. If you start plugging in different values to preserve the principal, which means keep that corpus, keep that death benefit around, and you're just going to live off the earnings. Or maybe you put an inflation rate in there. that's going to change that death benefit needed for your clients fairly substantially. So I think when we've all, or a lot of the talking heads or those experts out there, tell us 10 times income, is that really what the clients need? Do we need to go through this one pager? Once you fill this out, there's a button, I clipped it off here, but it says presentation. It'll pull out, it'll give you a 2-page presentation that you can walk through with your client. This is just the inputs. It'll change that wheel as you plug in different. Client has a $100,000 of death benefit and they need different types of cash needs at death. It'll change how much they need on that, and then you can print out a 2-pager, which is great to put in the client's file. Just for next year, you can recalculate and say, hey, look, we're in good shape, or boy, now you have another child, you're making more income, you need a little bit more death benefit. So not to belabor the point, but I think we all need to go back. I think the opportunity of lower interest rates, I said, gosh, your clients really probably need some more death benefit. Doesn't mean they need permanent, perhaps. Maybe you can add a 10-year term on top of that. So as you're talking about term insurance, pretty nice segue, huh? So one thing that a lot of folks have probably not spent too much time looking at is return of premium. There's a radio station here in Denver that one of the ads says, are you still buying that old term life insurance? A term life insurance where you don't get your premiums back if you don't die? So if you don't die, you're just throwing that money away. Well, 90%, 95%, 99%, most all the insurance sold in term insurance is sold as traditional, standard, pay the premium. If it doesn't, if you don't get a death benefit, it's a 10-year term, you've just thrown the money out the window. There's an opportunity here to show clients who might be looking for a little bit extra place to put some money. We can show them a guaranteed rate of return and show them something that's pretty darn attractive, something a lot more than that 1-year CD. Frankly, it's probably additional money they won't even miss month to month. So how does it work? Let's go through this fairly quickly. It's not rocket science, but you start with just a regular term policy. Now, I'll let you know, because of the current interest rate environments, we have actually suspended, and with AG 38, we've suspended our 25 and 30-year term product. So this is actually not available today. But I'm just saying that you're going to have an opportunity for a client that needs a 30-year term. And we have extremely competitive ROP, and this was a competitive 30 years. So grab another 30-year term product, plug it in here, and it'll be a great presentation for your clients. It'll give them the ability to say, okay, here's the cheapest 30-year out there, but here's an ROP, which is, I think, a compelling discussion. So if you can, a 30-year term is a 45-year-old select non-tobacco. It's sort of middle of the road. It's a good way for us to illustrate what it looks like. But if you take a look at the $3,200 premium, that's what the client would pay every year for the next 30 years to get $1 million of death benefit. And you know what? At the end of 30 years, that premium is going to explode. Client will say, I'm done. I don't need it anymore. Maybe they converted it during the conversion periods, but otherwise, it's gone. So what is the other alternative? Well, instead of $3,200, client could pay $6,100. What does that get them? Well, they're paying a little bit more, almost twice, each and every year, but they're going to be able to get a cash surrender value. They're going to get a reduced paid-up insurance amount that anytime if they quit, they said, look, in 15 years, 8 to 60 kids are out of the house. I'm taken care of. I've got all the obligations to take care of my family through retirement and all that. I don't need the insurance anymore. Well, I could get back $43,000, or I could get a $96,000 paid-up policy. A couple different options. And as you get closer to that 30-year time frame, you'll actually have, you paid $185,400 in premiums, and what you'll end up getting is $185,400 of cash surrender values. So it really does give the client different options. Now, how can you quantify that? How can you put a number on that to say, look, Mr. Client, look, Bob, I'm showing you these two things because you could pay if you're looking down towards the bottom, you could pay $3,200 in premium. Or I'm going to show you something you're going to pay almost twice, $3,000 more. And the question to you is that $3,000 a good investment into the return of premium product? Because you can get all your premiums back. So over the course of 30 years, when you paid an extra $2,900, that's going to have grown to $185,000. Let's just say, for argument's sake, you're going to put that $250 a month into your bank account or into a stock account or put it with your broker or give it to me, we'll put it into an annuity or something like that. What rate of return would you have to get over the next 30 years for that $2,900 to grow to $185,000? Well, at a 28% tax bracket, because this is tax-free money coming back to you as return of premium, 6.2% guaranteed rate of return. I'd say that's pretty compelling. Yeah, it's $250 that client may not even miss. It might be something they pay the premium once a year, it's gone, you know what, and down the road they start seeing these values show up. More often than not, the client's not going to die. Not very many term policies pay off on death benefit. That's why it's so cheap relative to the death benefit. But gosh, would a 6.2% interest rate be something that the client might think is a good deal, especially when CDs are only 1%? 5-year CDs are 3%. We've put an eye chart together here. Everybody wants to get real close to their screen. What it does is it'll basically sort of color code, and this is the males. If you look on the back side of the screen, there's a second side that actually goes through the female calculations. Not rocket science. These were using our 25 and 30-year return term products before we pulled them. But again, we aren't the only folks out there with very competitive term. But I'll tell you to think about for your client. Does this make sense? We looked at a 45-year-old select, so third column over, in the blue, 6.2%. Gosh, you could even do a 25 or even a 20-year, 4% return, guaranteed. Only a little bit more money, well, twice. But I mean, for a client, for term versus that half step to a permanent policy, that may be a compelling discussion to have with your clients. I don't know who else been showing this to their clients, but I tell you, we're seeing as a percentage of our sales, and this started probably 6 or 8 months ago, we're seeing more and more of the permanent products, of the ROP being illustrated and being sold, because it really does make sense. So that sort of closes out our ROP idea. Let's take a look at, there we go. We're going to take a look at a couple different ideas using a CD alternative. There's a couple different ways of approaching this. One of the things that we've found, and this is a product that's been on our shelf for quite some time, it's a real good alternative for a client that says, I've got a couple $100,000 in a CD. It's not earning me much money. It will probably pass down to my children. I don't think I will ever use it for anything unless it's catastrophic health issues. I got enough money to live on. I'm doing okay with my Social Security and my pension. I think I'm all right there. I mean, if I needed to get to it, gosh, as an emergency fund, there's a flood, something tragic happens. I'd like to be able to get to it. But right now, I'm really not earning much money. And one of the questions comes up to clients is, well, gosh, you're sitting in a bank account or a CD or money market. You could probably get a little bit better return, but they're just saying, look, I want to pull it off the sidelines. I don't want to risk it just in case I need it. But yeah, I wouldn't mind getting a better rate of return. So what can we show them? We've got this product called Strategic Accumulator. Strategic Accumulator years ago was our code word for high early cash value with Strategic Accumulator VUL, Strategic Accumulator UL, blah, blah, blah. This is the product that really has stood the test of time, has stood the ability to get to still be priced competitively, works with low interest rate environments. But it's a kind of a unique animal because it's a little bit different because we're showing here, and there's 2 different illustrations I'm going to show you. It's going to be, we're using 2 68-year-olds, well, showed here. We've got a standard and a preferred. 2 standards doesn't make much of a difference. As you start getting ratings, obviously it changes some. But the idea here is that this is a 68, a well into retirement couple that is comfortable in what they're doing and how they're doing it, probably got past that first 4 or 5 years where they're spending crazy amounts of money traveling and doing all sorts of. Now they've sort of settled back. So I've got a $500,000 CD that's really not earning me very much money. And it certainly, I'm not feeling that I'm going to need to use it, but I'm not really ready to give it to my kids yet. I'd like to have that cash if I had to get to it. And I'm not really excited about where it is. What do you have for me? Well, this is a strategic accumulator product. Split that $500,000 into 2 premium payments so the death benefit stays lower. This is a non-MEC. So if you did pull the money out, you see there is growth in it down, in the 10 to, 8 to 12 year, 13-year range. They could pull the growth out and not pay, it'd be tax deferred growth, tax-free income. First in, first out. So efficiently, it still has all the cash value perks of being in a true life insurance policy. Nice multiplier on the death benefit. 2 68-year-olds, arguably their life expectancy is probably somewhere in the early to mid 90s. I didn't show it, but this product doesn't quite last that long with just $250,000 premiums. Now the target down there is 155. It's a little bit modified commission. We can talk about that if you have cases you want to look more closely at. So this is one option for a client that says, "Gosh, I could multiply this 500,000 up to 3.4 million. I've got about 500,000 for the next 13 years if I don't put in another dime." At current interest rates, and we just lowered our crediting rate 20 basis points about 3 weeks ago. So this is current. Gosh, does that make sense for the client? Because right now they're earning almost nothing in the bank. So here they're earning, yes, it dips down a little bit for the first 5 years. You're off 10% or so, well, not quite 10%, 2.5% goes down to 180 to 488. But gosh, 3.4 million of death benefit, that would be a nice legacy to leave to my kids. What else could I do? Well, the other option is to get into a modified endowment contract. What does that mean? I think as insurance agents, I'm always of the opinion when I do case design, if in doubt, I'd rather not MEC it. But let's take a look at this. If you took the $250,000, this is the same 68-year-old couple, same health, standard preferreds. Take a look at the net surrender value. You've got over 100% first year. You've got less than, you had 99% second year, and then that thing starts to grow pretty nicely. So what have we just given the client? We've just given the client, except for year 2, at current interest rates, we've given them at least 100% of the value they put in. Do they have the $3 million death benefit? No, but we've given them 2.5 to 3 times that death benefit. Now, if you happen to live in a state that has creditor protection and life insurance, guess what? This might qualify. What other perks do we have here? Well, it's kind of a push between the interest that they're earning in the bank and the interest that they're earning here. They have the ability, after the first death, we have a free chronic illness rider that would allow access to the death benefit after the first death. Pretty unique, I think, in a survivorship contract. But you can show a client, now the target's still $62,000. Very attractive sale. And it doesn't mean you can either sell a 1.3 or 3.8. You can, that's a slide in between. So that's sort of the minimum non-MEC and then the minimum MEC death benefit. But gosh, what for a client that says, I'm not really sure what I want to do, and certainly 500,000 isn't the minimum. We've seen this with this. Typically, where it starts to get efficient is over $100,000 of deposit, which would be split into a 50 and a 50. But still, an attractive alternative for a client that's sitting on money because they might need to get to it. Great cash surrender value on this one looks real attractive. If they need it for nursing home or emergencies, health emergencies, chronic care, free rider after the first death on the death benefit. And it pays you a nice commission as well. So let's talk a little bit about Legacy Max. Legacy Max is sort of taking that last concept that we just covered, getting a little bit more in depth. Legacy Max is a strategy that we have on our software. It has a great presentation pieces, talks about the tax implications, talks about the estate planning implications. But essentially, the idea here is to say at death, and that's important, not only because life insurance pays a death benefit at death, but this is a client that's got money squirreled away that they said, look, this is not money I need. This is money I'm going to pass down to my children and or grandchildren. I want to maximize my legacy down, therefore we call it Legacy Max. Pretty creative, huh? So at death, we just want to show them that the CD or the IRA or the non-qualified annuity is going to get less money where they want it to go, kids, grandkids. They'll have less money than if we showed them utilizing a SPIA or a withdrawal from those accumulation assets and buying life insurance. So the question is, and this is exactly what the concept illustration shows, you build, it's okay, door one, the price is right, and here behind door one, you have your CD, your IRA, and you calculate what returns you're going to assume on those and what that at death in a graphic form, and then you can also do it year by year on a ledger, but the graphic is kind of nice because it shows them side by side, little flow chart. It says, okay, you keep what you're doing, and you're going to have an RMD coming out of it as long as it's a IRA, and you have different requirements for the type of asset that you have. And then we're going to say, okay, we're going to do a SPIA, or we can do a 10-year withdrawal, or whatever you want to do, lots of flexibility, and we're going to buy life insurance. Most likely it's outside of their estate. Why? Because it's safer if there's who knows what's going to happen with estate taxes, all that. But we can do it inside or outside the estate. We say, okay, and at the end of the day, we're going to pick your client's life expectancy. We're going to say, you know what, at this client's life expectancy, the client will be this many dollars better off by doing this Legacy Max strategy. So we have a great brochure. You'll find that this one is client approved. The idea is we're going to keep wealth in the right hands, meaning going down to where you want it to go versus going to the government. IRAs are one of the least efficient tools to get dollars directly down to Generation 2. We don't talk about stretches because a lot of inheritance, a lot of beneficiaries would love to see it sooner than later for houses and for this and that, but we can make an argument that this Legacy Max life insurance should even trump that stretch idea. But we're going to talk about, and this is a wonderful brochure that, again, client approved, walk through all the steps. I pulled a couple blurbs out of here just to show you kind of what the idea, how the concept works. The price of success. So, well, you've been successful, Mr. Client, but you know what? If you have extra funds or in a tax-deferred savings vehicle, and this is the most clear tool, or the IRA. As I mentioned before, if you die with an IRA, you not only have estate taxes and you have IRD taxes, so it hits you twice. But it can also work for non-qualified annuity, or we have I have an example in a minute that I'll talk about, a plain old CD. The IRS has a surprise for you. It may seek to impose 3 separate taxes on those funds before your children or grandchildren can use them. So what we're going to do is basically say, look, if your client has funds in an IRA or an annuity or a CD that they don't anticipate needing for retirement income, this might be just what the doctor ordered. The other thing I'll say, if there's any CPAs or anybody that does any tax planning for a client, as soon as you see an R&D in any of your clients' paperwork, boom, this should automatically jump front and center to say, you know, you're not really using it. Are you planning on it? You know, this is sort of voodoo money. Qualified money, I've heard a lot of people say, it's voodoo money. They don't want to spend it. It's kind of that last bucket they use. Well, does that make sense? Is that maybe we could show them how we just peel off a little bit of it. But this might be a really good idea for them. So this is what shows in the brochure. The left-hand column says, okay, we're talking about somebody with a $500,000 traditional IRA. Going down the left-hand side, gosh, Mr. Client, let's compare keeping that IRA. Next box, gross value at life expectancy, assuming a 4% growth rate, $1 million. Estate tax on the IRA. And we can fiddle with this depending upon where you think the client's estate will be, where you think the estate tax issues are. But this is saying, gosh, you're going to pay $550,000 of estate tax on that IRA. And then you're going to pay income tax as well. So the heirs, after that calculation, end up at $279. I usually, and I'll show it on the next example, I usually back out any estate tax issue, because who knows where it's going to be. If it's $5 million per head times 2, $10 million per household, you know, that takes that estate tax bite out of it. Certainly looks much better if everybody's going to pay 55% over $1 million or $2 million worth of net worth. But at the end of the day here, it's $279. Or if we did throw that $550 back in, it won't be quite that because there'd be income taxes on that as well. So maybe it increases to $700,000 if there's no estate taxes. Great. I'd much rather err on the conservative side, especially when you're making a comparison, because we can get holes blown on us all day long if we make more aggressive assumptions. On the right-hand side, what do we do to do this legacy max? Well, we set up an irrevocable trust. If the client is in a state tax environment, or if the client wants to get creditor protection in a state that they don't have, California, Arizona has a 2-year wait, Utah has a 1-year wait, Colorado's got 50,000. So would it make sense to set up an ILET anyway? Maybe. But at least if you want to get it outside of the estate so the death benefit doesn't count towards their gross estate, set up an irrevocable life insurance trust. Take distributions from the IRA. We can illustrate just taking the RMDs. We can illustrate taking a 10-year withdrawal from it. So a lot of different options there. We can illustrate taking a SPIA. In one of our examples, I do a SPIA arbitrage type of example. We have decent SPIA rates. I know there's a couple carriers out there that give you a little bit better. So whatever, go out there and find the best SPIA rate. Pay the income tax on the distribution. So if you're getting an $80,000 distribution and you're in a 25% tax bracket, to make it easy on me this morning, $60,000 net premium, you can go out and buy life insurance. And let's say that buys a $1 million death benefit policy. So then at life expectancy, you see that box down there. So we have the gross value life expectancy of the IRA of $1 million, and there's $1 million worth of death benefit from the life insurance. But guess what? No estate taxes. Whether or not estate taxes, who knows what's going to happen? Is it going to stay at 5? I doubt it. Most of the attorneys and most of the lobbyists I talk to doubt it, but it will be 3.5. Will it drop to $1 million? Who knows? But might have a little clearer expectation in a week or so, but you know what? I don't think we're going to have any clear, definitive, long-term solution, because whoever happens to get in power in a week. Midterm elections, everybody thinks will fall. If one party loses in a week, they expect the midterms to flip them back in power. So who knows? But let's take a look. No estate taxes, no income taxes. Net to the heirs is $1 million. Net to the heirs on the other side, on the IRA, well, arguably $279, and this is going back if the estate tax plan goes back to where it was in the beginning, that could be how much is left over after estate taxes and the income tax. Could it be higher? Probably. Well, yeah, definitely could be higher. Is it going to be higher? I'd probably pad this so it's not quite that stark, but still $1 million death benefit versus maybe that should be $600,000. I'd still say a 50, 30 to the 80% greater value coming out of that life insurance should be a pretty compelling discussion with your client. Maybe say, look, I like that, but I don't want to do the whole thing there. Who knows what I'm going to need to do? Roof gets blown off, car transmit, whatever. Guess what? Only do part of it. I've seen a lot of people with a couple $1 million IRAs and profit-sharing plans say, gosh, qualified money, I got to get some of this out of here. Great, let's just do this pretending we're going to compartmentalize only half of it. Okay, I spent a lot of time on that slide. Everybody with me? Perfect. 2 case studies. We're going to talk about and you can do it single life, you can do it joint, you can do it, you can do a variable, you can do an index, you can whatever. It could be, it's really any permanent policy. It depends on the client and you, which is the right choice. So we're just going to, for giggles, we're going to do one joint survivor, and we're going to do one, and this example number 2 really is this is a case that we just closed. We started 10 years ago, and we just closed it. It was a 2-step process. We closed it again in the last couple of weeks. But the first case study, 67-year-old male standard, 67-year-old female preferred. They have a $500,000 IRA currently earning 4%. Not too much different from that one brochure page that we just spent an inordinate amount of time going through. But I'm going to show you what does our illustration look like? What does the output look like? Can you take this right to your client? Paint by numbers, read page by page by page. If you don't want that many pages, go to our output tab, unselect the pages, skip it. We're going to assume that they have a 28% current income tax and income respective of the decedent of 31%. So we're going to back it down a little bit to make that, again, that's an argument to make your current IRA column look a little more favorable. We're also going to, I brought their estate tax liability down to 0. Again, so someone can't say, well, I think the estate taxes are going away. Well, maybe. Then we're going to talk about an 82-year-old female, and this will be that step 2 of the sales process that started about 10 or 11 years ago. We're going to compare it with a current CD, and this is what the beneficiaries had requested. That'll also be a good discussion. So don't forget, this is the 68 and 68-year-old joint survivor. But it's going to give you an idea, and these are just screen prints to give you some thought. When you give Mike or myself or Sheila or somebody a call, we can walk you through the case study. We can show you what how we got to these numbers. If you say, oh, that's way too aggressive, great. What numbers do you and your client, what numbers are defensible for you to sit down with the client and perhaps their kids or their other advisor, their CPA? So it makes sense. We want to make a fair comparison. So here we're going to look at, it's going to be a traditional IRA. Current value is $500,000. We're going to assume that it's going to grow at 4%, and they're going to take out just the required minimum distribution. They said they weren't planning on spending it. This is voodoo money. Usually it's the last thing to get spent. And then what we're going to do in the life insurance side, we're going to take withdrawals over 10 years. Why? Because John wanted to do that this morning. And we're going to take those 10 withdrawals, and the withdrawal amount is $59,000. And then we're going to go out and we're going to look at what is the life insurance death benefit amount that we'll be able to carry all the way out. And you can make arguments, okay, I want to guarantee forever, I want to do this, I want to do that. Lots of different options. Depends on the client and you. What are you really looking for? For the client information, we're still assuming a 28% income tax bracket, 31% income in respect of the decedent. Projected life expectancy, that puts them in the early 90s because it's a joint and survivor policy. Total estate value is $500,000. He said, well, gosh, John, I thought you said, well, I can't go below $500,000 because we know they at least have $500,000 because of that IRA. So it'll force you to do at least the amount that you're rolling out. I put a 3% after-tax growth rate of the estate. It doesn't drive an estate tax problem, so it's not going to have anything in estate taxes. Now, if you find someone with an IRA that said, I'm not going to spend, there's a chance that they might be in estate tax or at least have $1 million or $2 million net worth. So this is the I call it sort of the punchline of the illustration. There's a ledger that shows from the year they bought it all the way through age 121. What's their advantage of the IRA versus life insurance? Typically, there's a crossover point. Typically, they will have more money in the IRA at some point. As we know, life insurance, someone dies at life expectancy plus or minus five, maybe 10 years. Life insurance is a pretty good deal. If they live to be 150, you know, the economies of it definitely change. Economics. So going down this left-hand side, and this is, like I said, this is a screen print directly out of a case you and I will work on, or you and Mike Mallon or Sheila, who's my internal. We will help you through this. Left side, continue the IRA. Make the minimum amount you're required to pull out. Here's your protected IRA value. Here is the reinvested distribution. So that says, okay, your IRA will end up being you'll take out the required minimum distributions, pay taxes, reinvest it outside of the IRA, which won't be subject to income tax. It's already been taxed, but it's taxed every year. Net value to the heirs with no estate tax calculation in there is $811,000. If you look on the life insurance side, well, guess what? We were able to buy about $1 million worth of insurance. I rounded up just to make it easy on us this morning. Protected insurance. There's nothing in the IRA. We pulled it out over 10 years. There's no reinvested distribution. We've invested in the life insurance policy. Estate tax zero, income tax zero, net value to the heirs, $1 million. Potential advantage to the heirs, I'd say arguably on the low side. If we still think that 4% is a decent rate of return for what the client wants to expect or wants to get from a risk reward, a couple $100,000. Not bad. Well, what happens if we are looking at a estate tax liability? Well, the only thing I changed, if you look down towards the bottom of the screen, $3 million. So I said, okay, instead of $500,000, now they've got a $3 million estate tax, or the estate value, and it's going to grow at 3%. Now what does it look like? Well, again, I mean, it's a sliding scale. We can fiddle with numbers, but let's just take a look at this $500,000 projected IRA value, $400, reinvested distribution, the $550. Now it says, you know what, the estate tax is $511,000. The income tax due on that leftover is $52,000. Net value to the heirs now, like the other illustration we showed, a lot lower, $365,000. Guess what? The insurance has $1 million. If it's sitting outside the estate, that could go down to the grandkids. Do GST allocations, put it down to the grandkids, show them a lot of different ideas. But now you got $1 million down to the heirs when we're looking at about $365,000. I'd say that's a bigger winner. So as we're starting to get towards the top of the hour, wanted to talk about this case study number 2 that has a state tax liability. This is a case that I started about, how many years ago? This is about 12 years ago. And the case was two 72-year-olds. These two 72-year-olds had about $250,000 worth of CDs. And they were wondering, what else can I do? I worked with the agent, and we were able to get the gentleman a $600,000 policy. So we took the $250,000, bought a SPIA. The output of the SPIA, the annual payment out of the SPIA, life only, paid the premiums to carry this policy to 121. Everybody was fine, it looked good. The gentleman just passed away about 2 months ago. So now that's $250,000. And not the greatest economic environment in the world, we just turned $250,000 into $600,000. Well, guess what? Now that $600,000 is looking for a home. And there's 8 beneficiaries, and all of the kids but 2 went through the process when the agent and the father went through it. He's a math professor, an amazingly detailed person, asked all the questions. It was a very long, arduous process, but it worked. It worked like it should have, $250,000 to $600,000. Well, now, 82 years old, widow. She's looking for an opportunity. Where's the best place to put it? One of the kids said, I want to put it into a CD. Really? okay, what's the CD going to earn? They said, well, let's run 1% just for the heck of it. Well, the comparison was, this is actually was a $700,000 payout. So $700,000 they were going to put into it, be able to buy a SPIA on an 82-year-old female at 75.4 each and every year. With the assumptions down below, we ended up doing this. We said, okay, the current taxable account value is $700,000. So we're gonna run this left-hand side of this chart at 1%. We also ran it at 5. It really made almost no difference in the world. But the kids wanted to say 1%. I said, well, that's today. Maybe it'll go up. So we also ran 5. But this is, and on the right-hand side, it was plus or minus, dependent upon the underwriting. It was anywhere between, $950 and $1.2 million of life insurance. We said, well, let's just round it down to $1 million. And we sold it off of this. Current taxable value, $700,000, walking down through that left-hand side. Net value to the heirs, because of estate taxes and some of those things, $400,000. On the right-hand side, we're able to, using the SPIA, buying the life insurance, net value to the heirs of $1 million. Huge advantage. Now, this is the 1%. Like I said, there were some assumptions that they wanted to see that I thought were going to show too much bias towards the life insurance, because it was going to discount what I thought that CD might actually do for them. So, just kind of to recap, that's Legacy Max. Legacy Max is an ability to take an underperforming asset for what they want it to do. An IRA might be great if they want to spend it while they're living and they're going to go through it. But how about passing it down to the next generation? How about saying, great, there's a 90% chance it'll pass down, but gosh, you've got a great chronic illness writer. That's the only thing that you're really worried about. This is a great process to go find a way to get more dollars down to your kids. So I'm just going to wrap up in the last couple minutes with a couple different sales brochures we have, some marketing pieces. And one of the things that we've been getting a lot of interest in is what brochures does ING have that I can take out to my CPAs, to my attorneys, to some of my clients that, or maybe just for my own education, to be able to get educated, to be able to have a good conversation with them about some significant needs that they have in their lives that I can help them plan for with life insurance or with annuities and with whatever else you do. Special needs brochure. The brochure on the left is a great, it's a great consumer approved piece, about 4 pages front and back. Talks about what is it? I mean, what is the psychology? Unless you have a special needs child of your own, I don't know that any of us can really understand that. I didn't. After reading that, it does talk about all sorts of different planning thoughts. Not just life insurance, because we all know it's probably almost a guaranteed permanent sale. This child's not going to be able to take care of themselves. They're going to need a corpus of money someplace. Life insurance is a great way to get it there. But it also talks about how do you take care of the special needs child, but not let the other children feel like you're alienating them. That brochure in the middle talks about overview of special needs trust. It's just agent approved. I tell you, it'll make us a lot more educated when we're talking with a CPA or an attorney or the client about how do you set up the trust and why do you need a trust? Well, that's because there's state and federal programs that'll help your child down the road, and we don't want to, get them disqualified from that. And the one on the right, agent use only. But what it is, it's really just a case study. It talks about 2 50-year-old parents and what their estate looks like, and what the problem is taking care of their special needs son and their daughter. What was that solution? So a couple really nice pieces. Get a hold of Mike or email any of us, and we can get that information. Perhaps we'll put it out on the website. Great pieces. I know that as you're working with CPAs and attorneys, and maybe they don't even spend much time here, give them the pieces and try and educate them as well. The other thing that we've been running into more and more, and we created these unmarried couples or unmarried partners brochures, and it's I'm running into more and more second or third marriage of people who husband or yes.
John, we've got a minute left, and then this webinar is going to end, so we need to
Yep,
wrap it up.
okay, perfect. Well, then this is our last screen.
Okay.
This was an area of planning that we realized there were no primers or discussions about. There's more and more people that are, unmarried couples or unmarried partners, be it heterosexual or same-sex marriages. What do they lose in the retirement planning, the wealth transfer planning process? We've created 3 different brochures, and you can see here they're branded for a man and a woman, 2 guys and two gals, but it does walk through all the things that we can do to help them, both from the products that we sell, but also the people that we work with as an attorney. So our microsite, we'll skip that. At the tail end of Halloween, I thought this would be a fun little cartoon end with. This is an actual conversation that I heard one of the underwriters at INA calling ING, trying to get your clients a better rating. Said, look, if the client lets themselves be bitten by a vampire so I become immortal, only a wooden stake can kill me, can I get a better rate on my life insurance? So,
Don, thank you. Thank you so much. We've got about 30 seconds to wrap this up, and I hate to cut you short, but I want to let everyone know if they call Insurance Network right now, they will receive a sales tool that we've created for this webinar exclusively. John, if you would change the presenter over to me, I can show them that.
Let me see, where do we do that?
We're good, I'm good.
Oh, it's back to you.
See, there's the sales tool right there. Call us at that number right there, guys, and ask for Mike Mowen, and he will be able to get you that information. John, thank you so much for your time.
My pleasure. Thank you for everybody joining us.
Okay, great. And we're going to have to end this real quick because we are out of time. So thank you, everybody. Take care. Have a great weekend.